We think that the inflation situation in Japan is going to be reasonably stable, but given that it is rising, that the Bank of Japan would have a leaning towards raising interest rates. The challenge for Japan, I think, is right now with the uncertainty surrounding what the U.S. policy actual implementation will be, they may want to keep some bullets or keep the powders dry. And so therefore, the rate hikes potentially could be pushed out. Now, what does that mean for the fixed income market is right now, the 10-year bond yields for the JGB is going to be relatively stable, but there will be some volatility as speculations comes towards at least the end of Q1, traditional financial year end for Japan. The market may be starting to heat up in terms of what the BOJ would do.
So Kheng Siang, the stability around, I think, 108, 109 basis points are there about for the Japanese 10, right? Where would you put fair value for the Japanese 10? We've heard some people say probably 160. I mean, this obviously assumes that they are able to continue down the path of normalization and continue hiking rates.
Well, just more a personal view, I think the 10-year yield could be somewhere around 10, 15 basis points or 20 basis points higher from current levels. One of the things that the BOJ has to be careful is when they start to hike, they need to manage their expectations well. Look at how the dollar-yen has moved when they first hiked. So therefore, they have to be careful with that, because bear in mind that the higher JGB yields also hit investors, the banks, that are sitting on massive JGBs. As they try to raise interest rates, they need time for the bank's earnings to help cover some of the potential bond losses in the whole. So I think if they were to push the market or let the market run too far, that would be something I think they'd be worrying as well.
Okay, got to ask you, and let's circle back to what we first started talking about, and this is your expectation that near term, yes, U.S. yields may pick up, right? We're at around 450-ish, maybe we'll go up to 475, but in short order, they're going to start backing up. You think 375, right? You're saying that. How are you able to also say that duration is important?
Well, we think that for investors, they need to consider the path of interest rate movement, especially on the 10-year bond yields. At current level, we feel the valuation is attractive. No doubt there's volatility. Investors should start to begin to build up positions for long bonds. That's where they will be buying bonds on fixed income. Even as the bond market were to weaken, that will be time to build up more positions. We feel that the short end part of the yield curve will be more interesting, whereby they will be offering more value in the sense that we expect the Fed, if it will ease, will lead to a short end outperforming the long end.
How do you feel about high yield? I mean, spreads are super tight now.
Well, high yield is one whereby it has given a good, reasonable, positive outperformance last year. I think at this point in time, given the spreads are tight, we feel valuation is a little bit neutral to stretched, and so therefore the upside performance will be a bit more limited. That would be, I guess, some volatility could be very selective as well in terms of your positioning there, given that we are at the stage whereby the market has run itself to a level, and further gains will be fairly limited.